call the meeting to order. Roll call. Rusty?
Here.
Dr. Harrell? Here. Ms. Loretta?
Here.
Dr. Orlani? Ken?
Here.
Harvey? And Teresa. Did I miss somebody? Okay. Rusty, would you mind?
Sure. Please all bow our heads. Heavenly Father, we thank you so much, Lord, for the day you give us, for the many blessings that you continue to shower upon our community, Lord. We just ask that that you would open our minds, our hearts, Lord, that we could do your will, you'd have this organization, Lord. So much need in our community, Lord. I just ask that you would enrich our minds, Lord, with the things that we need to do to glorify your kingdom and earth now. These things we pray in your name. Amen.
Thank you. All right, we have public comments. Do we have any public comments, Crystal?
We do.
Okay.
We have two. First, Miss Suzanne Wetzel. Weitzel. You can come up to the podium.
Okay.
And you're going to have 3 minutes. After 3 minutes, the timer will go off, and that will be the end of your comment.
You can lower that if you want.
Yeah.
Thank you for allowing me to speak to you today on a subject that represents a crisis in the state of Florida, including Marion County. My name is Suzanne Weitzel, and I am the Board of Directors, President for the Florida 501c3 nonprofit entitled FLOST. The acronym stands for Florida Special Needs Services for Exceptional Dentistry. In Florida, the adult dental patients with intellectual, developmental, and acquired disabilities are not underserved. They are non-served. IDD patients include all aspects of neurological diagnoses such as autism, Down syndrome, various brain injuries, Parkinson's, and Alzheimer's. This is not a new problem, but rather one that we have been attempting to solve for more than 40 years. The current estimates suggest that adults lacking dental care with IDD include more than 400,000 Floridians. That is based on statistics from 2 years ago. We can only assume the numbers are far greater at the present time. However, the exact numbers are very difficult to acquire. At the present time, there are fewer than 5 dentists in this state that we know of that are treating the moderate to profound IDD population, and one of them is sitting right here. Existing reimbursement models are not adequate for this population and in no way meet the cost of doing business. We established the nonprofit May of 2024 to address the dire and worsening need for dental care amongst Floridian adults with special needs. Our mission is to treat patients showing respect and dignity that they truly deserve, and to train and teach dentists to work with this population. Treating the IDD patient is not a specialty in dentistry, but in many ways should be, due to the behaviors and medical issues that we are dealing with each and every patient. The pediatric dentists have been successful with treating the patients until they reach the age of 18. After the age of 18, these patients literally fall off the cliff to receive dental care. Initially, we will be seeing patients that fall between those that can be safely seen in a dental office and those that require hospitalization operating room because of their medical complexities. For our patients, we will be using behavioral modification techniques along with moderate sedation administered by a board-certified dentist anesthesiologist. We will also be recruiting out-of-state dentists who have been trained at dental schools with special needs experience. What do we need? We need capital of $1.6 million to build a dental office with 4 dental operatories and 2 surgical suites. We need a first-year operating budget for payroll, expenses, and equipment of $554,455.
That's effective.
That is wow. Well, that's the end of your time.
Okay.
Thank you. Thank you very much.
A little louder than usual.
Yeah.
Thank you. Next, we have Brian Creesaw.
Brian Creepaw, I'm at 3 Northeast First Terrace in Ocala. I attended the investment workshop roughly a month ago, where I didn't know what it was going to be exactly. It turned out to be, I thought it'd be educational. It turned out to be a whole restructuring proposal from Wilshire. It was billed as the most significant changes since 2014. And frankly, I'm concerned that there were only 3 trustees in attendance when the meeting started. One came in at 4:05, more than halfway through. So roughly half the board was not there for a major presentation on what to do with $300 million. I don't have much time, so I'll just say my bottom line is, if you won't be surprised, since I think Harvey here missed when I spoke in July. I don't know if you saw my 3 minutes, but you can do this stuff with 3 assets. You're making this all way too complicated. I believe that the proposal is too timid and has a landing position that's overly complicated, as what you have now is overly complicated. Why did it get this complicated? I'll tell you bluntly. One trustee entertained himself with these investments for a decade, and he needed a lot of playmates to talk to. That's why this thing is so damn complicated. 3 chief investment officers. Just listen to what it's marketed as, a chief investment officer alternative. Who has 3? We do, and we're still going to have 3. The consulting industry, and I see I'm about halfway through my time, is known for having a bias towards complication and favoring active management. In fact, insanely, frankly, your previous consultant was in the active management business. You want to know I didn't tell you about indexing? There were an active manager. It was just an insane hire. But Eisenhower talked about the military-industrial complex. Writers have compared the manager-consultant thing in institutional investing to that. It's a whole system. All the consultants are assumed to be pushing active management over complicated products. So you're told you need a specialist manager for alternatives, and it's going to take 5, 10 years to figure out if they even knew what they were doing. Here's the thing that also concerns me, and I see I only got a half a minute left. Here's the RFP that resulted in the hiring of Wilshire. I don't even have time to read the weighting criteria. Not a single one addresses or any of the information requirements to adduce from them hard evidence that they have a record or ability to help you hire somebody who will need a benchmark. Why? And that's probably not terribly unusual for hiring consultants. Somehow they manage to skate by without really having their feet held to the fire, and they come in and run these processes and they
Thank
want
you
to
very much. All right, thank you for both of your comments. Approval of the previous minutes, we need to approve first the board meeting minutes from September 29th. Do I have a motion?
Motion.
We have a motion from Rusty. Do we have a second? Second. All right. Any questions? All in favor? Aye. Motion passes. Now moving on to the approval of the investment workshop from September 29th. We need a motion.
Motion.
We have a motion from Dr. Harold. Do we have a second?
Second.
We have a second from Rusty. Any questions? All in favor?
Aye.
Motion passes. Okay, thank you. Kurt, we'll move into the CEO update.
Sure, I'll be real quick on this. So just a couple things I wanted to update the board. When we were going through the workshops, I was talking about bringing in innovation, state-of-the-art studies, and bringing potential treatments to Marion County. And I visited the Roskamp Institute in Sarasota, and they are leaders in research for neurodegenerative diseases, neuroprotection, age-related diseases, and they have numerous studies. So I was able to meet with their leadership and several of their, it was an open house that they rarely have everyone together for different studies. So I was able to learn about some of their studies to see if we could potentially bring some of their innovations to Marion County, and almost the same period of time, I've been trying for several months to get in to meet with the director of the McKnight Brain Institute out of the University of Florida, and it was actually Jeff Feller who gave me a name of someone who said, this might be the one gatekeeper that you'll be able to get a good meeting with, where you can explain what Marion County is doing, and maybe get something similar to what we did with the Grail cancer treatment, or cancer identification, where, again, that was one where it was study-based, and we were able to get a lot of our veterans in the study before we even started funding them. So there were lots of slots that were available, and because we found out about the study, we were able to get Marion County citizens to get the liquid biopsies for identifying potential cancer. So the McKnight Brain Institute has numerous studies for geroprotection, for neurodegenerative diseases, and also looking at approval of exogenous, let's say substances that don't require FDA approval, supplements that they've been looking at, or nicotinamide, riboside. These are things that you can get readily, and seeing how it impacts both brain disease and also heart disease. So actually, I just found out late last week, that Dr. Jennifer Bison, the director of the McKnight Brain Institute, wants to have a 3-hour meeting and tour and go through the facility. And so I'm going to bring that information back and hopefully learn something that we could set up a second meeting where I can bring you guys and hopefully find something that we can bring state of the art and hopefully move next door into our new facility. Also, just want to make you aware, we have a new sign up at Beacon Point. I don't know if you ever saw the last one. Oh, I need to roll it down. So the last sign was dark. And so at night, you couldn't even see it. And so now it really is a beacon of light at Beacon Point, because this is a 24-hour, 7-day-a-week operation for detox, for inpatient care, and so this makes it easier for clients as well as first responders, and also the sheriff's office. If they are transporting someone, they can easily see this from a distance, and so if you get a chance and pass by, it is lit, correct? Yes. That's good. And then lastly, I just wanted to introduce, I think we have a guest here that will speak about Active Marion Project, and we just wanted to give you an example of our goal with the Active Marion Project, where we find an amplifier, someone that is really representative of bringing together a group to increase their number of steps, and it really embraces what we're trying to do with population health in Marion County. So I'll let you take it away.
Thank you. Good evening. Each year we do a very large and competitive step challenge starting in October through December with Marion County Public Schools. This year we have 66 teams, which is the most ever, and over 1,000 participants. It was brought to our attention by our CHP staff that a team, a very special team, housed at Howard Academy, was really taking it to the next level. They're really truly in it to win it. Dr. Melissa Coleman is Director of Federal Grants and Programs over at Howard Academy, and when she came on board recently and took over our role of amplifier, we were impressed with the little videos and pictures that we were receiving, and just truly when I go over there, it's a different culture, a different vibe, different culture of wellness. So we asked her to come over this evening and just share with you guys as an amplifier what she is doing to encourage and motivate and bring that team to the next level through our Active Marion Step Challenge. So I'm very excited to introduce Dr. Melissa Coleman.
Welcome.
Thank you. I do need to move this down. So good afternoon. Thank you so much for having me. My name is Dr. Melissa Coleman. I'm a director of Marion County Public Schools, and I oversee our supplemental funding for the school district. And I'm excited to be here today to celebrate something that might seem small at first, but it actually represents something bigger: the power of consistency, teamwork, and wellness. Over the past few weeks, we've turned everyday routines into opportunities to move more, support each other through the walking challenge, and have a little fun while doing it. So many of our staff have stepped away from their Excel charts and computer screens and finance budgets, and had morning walks, had lunchtime laps, afternoon break sessions. They put on videos for 15 minutes and done walking challenges together with music, and done lots of evening strolls at their house with their families. Every one of those steps added up, so I think we have sat at the top of the leaderboard. This is not the whole team, this is just the people that happened to be in the room that day. What I love most about challenges is that it's not just about the competition, which they love, but it's about the community that comes with it. We encourage each other, celebrate progress, and remind ourselves that wellness is not just a program, it's a mindset. And when we take care of ourselves, we bring our best selves to our family, to our work. And so we've been delighted to participate with this STEP challenge along with others in Marion County. And we thank you very much for the opportunity. And of course, congratulations to all of the teams, no matter where they placed on the leaderboard. They took a step towards better health, and that's always a win. So thank you again for bringing the STEP challenge to Marion County and for inviting us to talk today.
Thank you.
I have a question. Do you think y'all will continue walking after the challenge is over?
I think so. We actually have, I'm new to Marion County, so I am actually in the process of moving to Ocala as we speak. And I close on a house in a couple weeks. And so I've always just encouraged folks to have walking treadmills at their desk, and because sometimes you get in these offices that kind of create an imbalance when you're sitting there and working so hard on particularly maintaining budget Excel sheets and that sort of work. And so I encourage them to find a way to have work-life balance in the office, and give them permission to step away from their desk and go walk around for a minute, maybe to reset and that sort of thing. So many of them actually have the walking pads at their desk, and they've kind of taken walks and that kind of thing. So I'm hoping it jump starts the spirit.
Good.
Thank you.
Absolutely.
We've got Kurt is going to test out his technical abilities, because we're going to have 2 different Zooms. So we'll not simultaneously, one after the other.
Yeah, 2.
Good start.
I like this.
Hi, everybody.
Hello.
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 Hi,
Bill.
Keep it.
One more.
Do we have everybody now? I think I have everybody
I
right.
think we're close enough.
Okay, Nathan.
Can you hear us?
I can.
Great. The floor is yours.
So can I be on the order here? Is it Truist, Crescent, and then Brisbane?
That's correct.
All right, Mike, I'll hand you the floor.
Wonderful. Are we sharing a presentation, or does everyone have it? What's the what's the preference?
It might be easier if you share. Is that okay?
Okay. I'm happy to share. Let me do that now.
Okay.
Is it in our board package?
You can see it.
Who's in the documents?
Okay.
It was in.
Let me know.
Yes, we can see it.
All right. Perfect. All right. Let's talk about the quarter. So, had a nice rebound in the overall markets. Portfolio took advantage of that, particularly in our equity asset classes for the 3rd calendar quarter of 2025. So from a performance standpoint, portfolio was at 4.36%. Strategic benchmark was up 410. The vast majority of the returns were driven from large cap domestic growth stocks. And this is a market where we are truly managing to the market that we have, not necessarily the market that we wish to have. Nathan and I were talking about this the other day. And this is a market that is absolutely favoring passive index strategies versus active managers, particularly in domestic equities and even international equities to an extent. So we kind of deconstruct the portfolio, and I'll just be brief here, and I will talk about a change that we did implement in the portfolio during the time period. The total U.S. equity performance up 7.74%, with large cap equities up a little over 8%, mid and small cap together up 6.4%. We did make a change in the portfolio, taking out our small mid-cap manager, Eaton Vance. So this is a strategy that for a long time had generated nice excess returns over the benchmark. But on a year-to-date and trailing year basis, we did put them on watch. And on September 15th, we moved away from the strategy completely. And the proceeds were split evenly between passive mid-cap and passive small cap. The international portion of the portfolio for the quarter generated a return of 5%. Both the growth and the value strategy slightly underperformed benchmarks. It was just very difficult for active managers to keep up with the strong rebound. Any cash positions in their portfolios or any technology positions, particularly for the growth portfolio that the managers couldn't own a full index share of, was a small source of detraction relative to benchmarks. Private equity contributed 3.32%. When we look at the alternative investments in the portfolio, Neuberger Berman, Equity Long Short, and Pointer Management together continue to generate strong returns for the portfolio. Do keep in mind that these are reported with a month lag, so still some catching up to do relative to benchmarks there. But pleased particularly with the Pointer Management and Equity Long Short strategy. And then kind of rounding out the portfolio, fixed income. We have that anchored with a U.S. aggregate strategy, which is Dodge and Cox. The 1 to 3 month T-bill position, we are going to be taking out of the portfolio tomorrow ahead of the Fed rate cut. That was kind of always the intention. Using the 1 to 3 month T-bill when T-bills had higher yields than kind of the rest of the yield curve. With the yield curve steepening, taking that trade off and just extending out duration. And cash equivalents, just over 5% of the portfolio in the quarter. Public real assets, largely commodity positions, up about 5%. And then just rounding out the remaining asset class in the portfolio, the marketable alternatives, generated a return of about 4%. So positive contributions from all asset classes, but by far the leader for the quarter and on a year-to-date basis are U.S. long-only equities, particularly growth, and that's where we are most overweight in the portfolio. So I'll pause there and see if anyone has any questions.
Well, one quick question maybe from me, Mike, is you talked about the move from Eaton Vance to a passive index, just how the portfolio is positioned today from a structural perspective, so not necessarily active management versus passive, but large, mid cap, small versus, say, a Russell 3000 index, what views are you expressing?
And so let me share that. So with regard to large, mid, small, we're overweight large, underweight slightly mid versus the Russell 3, and building to an overweight, trying to do that opportunistically with small cap.
Thank you.
Other questions for Mike?
And just one more agenda item, if there are not questions. The subscription period for Harbor Best 2025 private equity is currently open. I know that there's some conversation about alternatives and privates, but if it is of interest for the committee to commit to a vintage allocation for 2025, this would be the period that we would need the okay to start the paperwork.
Okay. We're going to be discussing that a little bit later, Mike, and Nathan will get back with you.
That's perfectly fine, just wanted to put it on the table. Either way is great.
All right, thank you.
Mark?
All right. Can everybody hear me pretty well?
Yes.
All right. So good evening, everyone. So the portfolio markets have been on quite a run since we last met, with the portfolio and strategic benchmark both gaining about 9.5% in the last 6 months. Stocks have rallied across the board, with U.S. and international equities both rising 20 to 25%. But rather than reviewing the performance report and portfolio transition, I was instructed to focus mainly on the U.S. equity composite, how it's positioned, and the reasoning for our allocation decisions. So with that said, I'm going to turn to page 28 in our packet, since you all don't have that, I guess, in front of you. Historically, stock market, I'm sorry?
No, it's okay.
Okay. Historically, the stock market's annual return has averaged around 10%, depending on the period and index measured. But looking at the chart, I just want you to notice how much higher equity returns have been across all these periods.
Hold on one
compared to-
sec. You said what page?
I'm on page 28 in my packet, but I don't know if that's the same as your board packet.
It was 16. 16?
They got it now.
Thank you.
Okay, great. So I just want you to notice how much higher these returns are than that historical average of about 10%. And if we turn to page 30, I'm going to talk about kind of active versus passive. It's no secret active managers have underperformed benchmarks over the last couple of decades, and I think it's important to discuss a few reasons behind this trend. In response to the 2008 financial crisis, the Federal Reserve's easy monetary policy, its low interest rates, and massive liquidity packages profoundly impacted the market environment. Low interest rates drove investors into risk assets such as equities, which disproportionately benefited growth stocks. And furthermore, the Fed's quantitative easing programs suppressed volatility, thus reducing the need for defensive and/or tactical positioning, which are areas where active managers have typically added value. And finally, the economy has mostly experienced low inflation, leading to predictable cash flows and higher valuations for growth companies. With all that said, at Crescent, we also favor indexation, particularly in more efficient areas of the equity market, such as U.S. large cap stocks. So looking at page 31 on the screen, you'll see this is how we consistently position U.S. equity exposure by allocating about 80% to passive strategies and 20% to active managers. And I expect this to continue, where we're emphasizing low-cost indexation in the future with just a little bit of active management on the small cap side. So why are we using any active managers if it's been such a tough slog for them? Passive strategies have also benefited from a handful of tech stocks driving the returns, most notably the Magnificent Seven companies of Apple, Microsoft, Amazon, Google, Meta, NVIDIA, Tesla. But given their diversification requirements and risk controls, many active managers held smaller allocations to these few names, which contributed to their persistent underperformance in the rising market. And since indices like the S&P 500 or the Russell 3000, which we're benchmarked to, are market cap weighted, these winners automatically became a larger portion of as they rose in value. So if we look at this chart on page 32 that I have up on the screen, you probably already noticed we've never seen so much concentration in the market, with the top 10 names making up approximately 40% of the S&P 500. And then said differently, by this measure, the market has never been less diversified than it is right now. So this next page, we're going to talk about how active managers have performed in previous downturns. This chart shows 28 market corrections from the past 35 years, and in more than 75% of those corrections, actively managed funds outperform the index by an average of 1%. Now, I'm not saying a correction is imminent, it's just as if history is any guide, I would expect active managers to provide some protection during the next downturn. So if we turn to page 34, you'll see passive and active management trends tend to go in and out of favor, and the last 10 to 15 years have clearly been on the side of indexation, with this gray line consistently above the blue line. However, if we look back at the period between 2000 and 2010, which included two bear markets from the tech bubble bursting in the early 2000s and 2008's financial crisis, active management more than held its own during those periods. So looking at how we're positioned on the large cap versus small cap and value versus growth, this is how the U.S. equity composite is positioned right now. It's this top left box, but more importantly, it's really looking at this relative weight to the Russell 3000 index. And as is the case today, we've consistently tilted more toward value stocks than growth stocks, and had a higher relative weight to small and mid-cap companies, which is mapped historically on this next page right here. And on average, we've held about 60% in large cap versus about 40% in small cap, and then about 55% in value stocks versus 45% in growth stocks. And if we look at page 38, this compares the rolling one-year returns of the market cap weighted S&P 500 against the returns of an equally weighted S&P 500. Essentially, since the start of 2015, where all you see is these green lines for the most part, the market weight index consistently beat the equal weight index as larger companies outperform smaller companies. However, looking at the periods when the market declined, such as the tech bubble, financial crisis, European sovereign debt crisis of the early 2010s, and the early days of COVID, equal weighted index performed significantly better, highlighted by these gray bars right here. And then on page 39, we're going to show the yearly performance of various market caps and styles with cumulative annual returns in the far right column. And as you may notice, growth outperformed value, and large outperformed mid and small in most years. And this has led to large valuation dispersions, which I'll show you on this next page. The chart on the left shows, even by historical standards, that value stocks are trading at a sizable discount to growth stocks. And the tables on the right illustrate that while all styles and market caps trade at a premium to their 20-year average price to earnings ratio, if you look at the top row, which is the large cap area, and then the far right column, which is the growth area, they're trading at significantly larger premiums than normal. Then this next page, it's going to show valuations are high regardless of whether you're comparing stock prices to their revenue, their book value, their earnings, or operating income. And as you'll see, large cap valuations are trading between the 94th and 100th percentile, meaning on some measures, stocks have never looked more expensive. Small mid-cap stocks are trading around 75th percentile to their history, and although they also appear expensive, it's not to the same degree as large cap stocks. And then flipping over to this next page, this chart compares the return of the S&P 500 with the earnings and dividend growth since the end of 2005. As you can see, the lines closely track each other until about 2020, when the government and Fed injected massive amounts of liquidity into the system in response to the COVID crisis. And since then, stocks have soared well beyond the earnings and dividend growth, and to the point where my investment team estimates the S&P 500 is approximately 30% overvalued. And if we turn to the next page, it's similar to with small cap stocks against their earnings and dividend growth, but they only appear about 12% overvalued based on next year's earnings and dividends. So in summary, while we don't have a crystal ball that can predict what comes next for the U.S. stock market, and valuations are not necessarily a good predictor of future returns, I still believe a modest allocation to active managers in certain segments like small and mid-cap stocks and maintaining a slight tilt towards more modestly priced equities will help preserve capital when we inevitably face another bear market. And I guess at this point, I'd like to open the floor for any questions you might have.
Questions for Mark?
Yeah, one, if you could send, so the presentation that we had finished at page 16, so we did not have any of those slides. If you could forward those, they look like good information, but we'd like to study it.
Yeah, happy to.
Anything else? Thank you, Mark. Adam?
Adam, you're muted, sir.
Yeah, good evening, everybody. So we'll follow the same guidelines that Nathan asked us to follow, and just focus on domestic equity, portfolio construction, how are we allocating the portfolio across large cap, both growth and value, small and mid cap, and then also discussion over passive versus active. I'm going to speak in more macro broad terms, and then TJ can get more granular on some of the active versus passive, specifically the active managers where we're seeing some outperformance versus their representative benchmark. So we're happy with the portfolio construction. Overall, we've seen total performance since inception is slightly above the policy benchmark. We're taking less risk, with less volatility, less risk. It's been a lower downturn, maximum drawdown during some of the worst periods you see on the bottom two lines. And we got positive alpha of 0.69, so our up capture of the portfolio is 94.25 of the up, and then 90.78% of the down. I know we talked about it in the past, our style is more conservative in the active management. We tend to have more conservative managers, but in a broad sense, across the portfolio, we're happy with the portfolio construction and all the changes that have occurred over the last 12 or so months. We still have some work to do in the private equity, which we won't talk about. I know we spent a lot of time talking about that, but that'll get closer to the targets over time. Quickly, as it relates to the domestic portfolio in a broad sense, 28% of the growth equity, if you include domestic and international, 28% is in domestic U.S. equity. Out of that 28%, it's about 50-50 passive versus active. 14.14% is in passive, and then 13.9% is in active. Active managers across the domestic equity, we have 4 active managers. 2 of those managers, both in the large cap value space, have provided positive returns, positive alpha, and been above their representative benchmark. 1 in the large cap growth space, JP Morgan large cap growth, is basis points equal to the benchmark, but taking significantly less risk and has positive alpha. And then the 1 below is our small mid-cap manager, Earnest Partners, that TJ is going to talk a little bit more about. I know we're not focusing on international, but we also have international split 50-50 with passive versus active. And then I'll turn it over to my colleague, TJ.
Thanks, Adam. Adam's right. We have a 50-50 balance on the active versus passive piece of the equation. But if we pull that onion back one layer and say, okay, well, where are we more active and where are we more passive? On this page, we have the total fund, growth assets in the dark blue, then we have U.S. equities in the light blue. And the conversation keeps coming up over the last, especially 3 years, as we've been in a risk-on environment coming out of 2022. And we focus on the last 2 years where U.S. equity for our portfolio, net of fees was up 23.4, and the benchmark was up 26%. So where's that difference? Where are we getting the performance difference between almost 3% between the benchmark and our portfolio? I think it's that ongoing conversations about overall market, and it comes down to everything Mark talked about. He did a great job talking about the theory behind active versus passive, where we've seen it come from, and the thought behind adding active to a portfolio now. So I won't go through the education there, and our thoughts are similar, looking at the market and looking forward. But if we now pull that layer back and look at the 2 man and 3 managers on the left side. We have in gray, it's Boston Partners, large cap value, Columbia dividend, and then the passive large cap value. If we focus on value first, we are 60% active and 40% passive in the large cap value space. When we look at the manager performance of Boston and Columbia, and we go all the way to the right-hand side of this page, since inception for both of the managers that are above the benchmark, Boston is up 12.35 net fees, first 10% on the benchmark, and Columbia is up 11.75, first 10%. So we've seen very strong active returns in the large cap value space. It's been better to be active than passive in large cap value. Now, if we go down 2 more lines and we look at JP Morgan large cap growth and the Vanguard large cap growth, in the large cap growth space, it's been very, very difficult for active managers to add value. We're 70% passive in the large cap growth space. We said, okay, there's concentrated portfolio or concentrated positions in the benchmark. It's going to be tough to add value in that space until volatility picks up. But even with that, even with the concentrated portfolio or the concentrated positions in the benchmark, if we look at JP Morgan large cap growth, since inception, gross in line with the benchmark, up 23.5. The benchmark's up 23.55. Take net though, 23.18. If we adjust for alpha, and we talked about alpha earlier, it's just a fancy term saying, given the amount of risk we've taken, it's a lower risk manager. We would expect to keep up, not outperform in an up market. We really focus on down markets. And if we go back to 2022 when the market was down, or specifically U.S. equities were down 19%, our portfolio was down 15.5%. If we go to earlier this year, the first 4 months of this year, from January to the end of April, when the market fell from all-time highs down 20%, during that time period, at the end of April, from the beginning of the year to the end of April, the benchmark was down 5.5, we were down 4.4. So Adam talked about being more protective in markets of volatility, times of volatility. We do protect on the downside. We keep up on the upside, but we haven't seen a lot of volatility, prolonged volatility since 2022. With that, we did have earnest partners in this mid-court. We're looking forward and we're taking a look at the portfolio. Not only have we seen, active managers keep up and outperform in the large value and the large growth space, the one manager that's been a little bit below has been the Earnest Partners SMID Core. The SMID space recently has been a very tough asset class to outperform, giving a few concentrated names in those benchmarks as well. We're having conversations about what do we do in that space. We're taking a look at maybe moving a little bit more passive in that space as well. But we've been slightly overweight, small and mid cap compared to the benchmark. That's something we're also taking a look at, maybe getting back towards being in line with the benchmark from a weighting perspective. Overall, though, 3 out of the 4, managers are adding value in the domestic space, and that focus on earnest has been where we've had a little bit of weakness.
I would just add one final comment, TJ, and group. The discussion about potentially going 100% passive in domestic equity or in equity in general, we would caution against that for a lot of the reasons that Mark laid out. We have a cyclical market. It's difficult when you've had so many years out of the last 10 in the chart that Mark had, which we use also, that has large cap growth as the #1 performing asset class among all asset classes. We forget, we all have short memories, that there can be and will be some periods of time of significant volatility. We typically tend to go more in passive when we head that volatility. So if we've had a significant sell-off to the downside is when we potentially make decisions to go more in passive. Today, now, with markets at all-time highs, not to say they don't have some room to go higher, we would caution about going 100% passive. We had the discussion internally, a lot of, the drum beats getting louder. Are we in a bubble? We're getting to the tail end. Are we a little ahead of our skis with the AI trade? And the question is, if you think about the dot-com bubble, are we in 1999 or are we in 1995? We think we're in 97 or 1998 time frame, so probably some more time to go. But we just wanted to follow and sort of wrap up the passive versus active, and happy to answer any questions for the group.
Any questions for Adam or TJ?
One quick one from me, similar question to what I asked Mike, Adam and TJ, but maybe phrased a slightly different way. What proportion of the tracking error you're taking within US equity is structuring versus active passive?
Tracking error meaning where so I think if we look at a percentage, a majority of the tracking error from the benchmark is in the earnest partners performance differential. Now, we did have some overweight to value over the last, I would say, 18 months, which would have provided tracking error. So it's been more an allocation decision over the active management conversation. So we were overweight value at one point over the last 12 months, and we brought that equal weight almost 12 months ago. Towards the end of last year and the beginning of this year, we brought those equal weight. So the difference between our benchmark and our performance over the last year has been a lot more on the allocation decisions over active versus passive, excluding earnest, where we had the biggest difference between the benchmark and manager performance.
Good, thank you.
No other questions? What did you just do?
That's nothing.
Literally.
Okay, thank you, everyone.
Thank you.
Thank you.
Thanks, everyone. Thanks, everybody. Have a good evening.
You as well.
Thank you.
Now you told Nathan you're going to zoom him in again?
We'll see. Oh, look at this.
Okay.
Amazing.
Yeah.
Deborah will be so proud of you.
You can't expect this every time.
Okay.
Hello again.
Hello.
And Evie. There she is. Okay. You have the floor.
All right, let me share my screen. Pick the right one. Go. Take us away, please.
Yeah, so we did a bit of an inverted fashion tonight. We have heard from the OCIO providers first, and now we'll go ahead and just provide a little bit of context for why things were structured that way, and then, commentary about the aggregate portfolio performance to help further contextualize it. If we go ahead and get started on the executive summary page, we have included this to give you a sense of how the total fund is performed relative to the benchmark. But I do want to emphasize here that this is only 3 years worth of data, as we always talk about. So it's not quite a long-term time frame over which we would use it to make and use it as an input to inform any major strategic decisions. But it is still a helpful summary that we want to provide you with going forward, so you don't have to dig too deep into the weeds to get the headline of how the portfolio is doing. So we'll focus on the top left quadrant here for tonight. The portfolio is ahead of the CPI +4 benchmark across all time periods, which is great in terms of that sustainability of the corpus that we're always focused on. So that's one check mark in terms of the success of how the investment program has been performing. If you drop down to the second metric there, which is the policy benchmark, the portfolio has lagged over the time period shown here. And some of the biggest detractors have been manager selection, particularly within U.S. equity and directional marketable alternatives. And this is why the format of today's presentations followed a bit of, the OCIO presentations followed a bit of a different format because we thought it would be helpful for them to each do a deep dive into how their U.S. equity portfolios are structured and get into their investment philosophy and perspective on the case for active management. So hopefully that was something that was helpful for you all to hear tonight. And then the last thing we look at is the peer rank. And again, this does include a universe of peers of all kinds of diverse foundations with different objectives and asset allocations. And in a few slides, I'll get into some more details about what's included there and how to think about that. But let's touch briefly on the markets, not too much since we got into a little bit of that during our previous discussion. If you move to the next page, please, Nathan, the page after this. So a brief word about markets. We know the U.S. market was up for the third quarter, and international markets also continued to soar. The yield curve was down across maturities, and the current expectation is, again, for 2 more rate cuts before the end of this year. We move to the next page. You know, sometimes during these quarterly discussions, we like to show you this quilt chart. And again, this just shows for each calendar year, the past 6 calendar years and year to date for the current period. It shows the best to worst performers by asset class. And a couple of things that I thought were interesting here to point out is that although 2025 again is just year to date, emerging markets rose to the top of the board for the first time in over a decade. And I think that that's just a nice reminder of the fact that having that diversified exposure during the portfolio does give you the opportunity to take advantage when the pendulum eventually swings and things shift around in the markets. Also wanted to point out that developed markets are a close second, but if you look all the way to the far right where we have annualized 5-year performance, the US equity still rises to the top, and we know that that's been the prevailing trend. You move to the next slide. We'll talk a little bit, slide 7, Nathan. We'll talk a little bit more about peer data as another reference point. Again, this includes a very broad universe of all of the foundations that we have in this particular database. And while the portfolio did deliver positive absolute return, we know that it's disappointing to see that performance has trailed the peer group median, but that is largely due to the Marion County portfolio having a lower risk profile, and that is intentionally by design because we are very much focused on being able to protect capital during volatile markets and to preserve the corpus value in order to allow you to have more impact for the important work that Marion County does in the community. We move over to...
Let me ask a question about that. So,
yes.
Because we put it, so when we look at the population of people that we're comparing ourselves to, is it not an apple, so it's not an apples for apples comparison because our risk profile, am I correct in stating that our risk profile is less than our peer group on average, and so therefore, we're taking more conservative approaches, and so in an up market, we're not going to benefit from that as much, but in a down market, we're not going to be penalized as much?
Exactly. There are a few ways that you can go about it, but when we are focused on capital preservation and that, in this particular instance, that long-term time horizon, giving that priority a little more weight, that does mean you will give up some of the upside participation, but again, if you experience less losses during the downside, you're preserving more capital, a higher base from which to compound on in the future. So that makes the portfolio much more sustainable and robust over the long term.
So would another way, so again, I'm looking at the OCIO's performance, and nothing about their performance has been super encouraging. Our policy benchmark, our performance versus benchmark is not good. Peer rank is not good. Now, what I'm trying to do is get calibrated. How much of that is actually the OCIO's performance relative to the peer group and the benchmark versus, kind of the handcuffs we put on them with our risk tolerance?
Okay, so let me isolate one part of the question. When you talk about peer performance, I do want to emphasize that this is something that should be taken with a bit of grain of salt to circle back around to the initial question that you posed. Some of these other peers in this group have a much higher allocation to equity, for example, than you do. So that is going to mean a lot more volatility along the way, a lot more potential downside risk that Marion County wouldn't necessarily experience, but it will it will cause the results to look different over these periods that we're looking at. Another thing I should mention is they have different mandates. There are some foundations included in here who fundraise, they have donors, they've got all kinds of different things going on in the portfolio, so that does allow the portfolio to take on, again, a little bit higher of a risk profile, whereas Marion County's situation is very different. So I just want to underscore some of that context.
Yeah, so peer group isn't really a peer group, as I mean, so peer to me.
Yes, it's not one-to-one.
Okay, so it's, again, because if it's not mean, because if it makes us look, artificially bad, well, then that makes, so is there a better peer group that, what I'm trying to do is, find a relative amount of performance, how our OCIOs are doing, relative to others. And if that metric, kind of understates their performance or overstates, penalizes them. I'm just trying to come up with a measurement that we can rely on or count on to measure their performance, and whether we need to look for another one or continue with them. And so, again, the scorecard that's provided doesn't show anything really that's very performance about any of them. Again, based on benchmark and peer group and things like that. And I'm not based on that data. It's like, okay, we need 3 new ones, or 1 new one, or to do something different. But what I'm hearing you say is, well, hold on, there may be some data in there that's, confounding that.
Yeah, I mean, it's a good question. So what we've tried to do is solve for that with the policy benchmark. That is one quick way you can see how is the OCIO provider on track, outperforming, underperforming the policy benchmark, and then within that we can look to different areas of the portfolio. If in aggregate they're not, okay, well, how are they doing on U.S. equities? How are they doing on the different asset classes? And that's something that we'll get into later in terms of a lot of the strategic work that we're trying to do. Are the OCIOs that we have as they stand now the most skilled to execute the mandates that they've been given? And I think that's what we're really trying to work on for the future state.
So benchmark versus peer rank would be a better measure.
Policy benchmark is a better measure because it's what we're actually asking. It's the strategic policy that we're actually asking them to invest in. So how are they executing versus the actual mandate they've been given?
All right, thank you.
Do you want to add something, Nathan?
I think I need to say that, if you began on slide 2 in the top left-hand chart, I would say something like 50% of the importance really is just, are we achieving our strategic goals? And this only goes back 3 years, and the answer has been yes. Once we use Truist as a proxy, going back 11 years, the answer is no. And then the question becomes, why not? Is it because you've got the wrong benchmark, so it's Wilshire's fault, or Wilshire, the trustees as a collective, or is it a failure of active management? And that's where we've seen, we don't have it here, that the benchmark return has actually done its job over the longest time period where we can look at it. It really has been aggregate, unsuccessful active management. And that's why when we get onto it, we are going to be recommending a RFP process to make sure we have the best providers in place.
Okay. And that's the slide that sent me on this tangent.
Okay. Any more comments you had?
Yeah, really quickly, let me just round out some total portfolio comments. If we can go to slide 8. Looking at the asset allocation at the total fund level, the portfolio is still overweight to public equities relative to that target. And that is largely due to still working to build out the alt exposure, but as you know, that's something that's on the table for discussion and coming up here in a few minutes. So I did want to point that out. And then the last one I wanted to land on was slide 13 for us, Nathan. In terms of the total portfolio results as they stand for the quarter, the fund was up 3.83%. So it did lag the benchmark by 50 basis points. And in general, the asset allocation, I think what's interesting and underscore the discussion we're going to have today, the asset allocation did positively add value. So namely, being overweight to U.S. equity, for example, in a period where this asset class did outperform the total benchmark, was additive overall, but this effect was completely dwarfed by manager selection, detracting value mostly in the U.S. And international equities to some extent, but also in marketable alternatives. So this is what we're going to talk about and what's really the driving force behind the recommendations that we're bringing to you tonight. The total portfolio market value as of end of September with these changes stands at $327.4 million. Any other questions? Okay, over to you, Nathan.
All right, let me, okay. Right. Okay, so we've covered 1 and 2. Really, now 3 to 8 is the strategic items. So this very much, follows on from, all the work, frankly, we've been doing over the last, I think 18 months very intentionally, and follows on from the September investments workshop where it seemed that there was a consensus to proceed with these efforts, and Ken's kind of really verbalized the rationale for it, right? We want to try and see better performance, and we want to try and tackle where the issues actually are. So here we've just listed out the decisions that we'll be asking the trustees to discuss and to make today. So in turn, the first one is whether to initiate an RFP process to appoint an alternative specialist OCIO. And within that, there is a decision on it's a one-time avoided cost because the work that we would be doing isn't covered within our existing contract. The second decision is then on the RFP document itself, and we've kind of given the highlights of what's included in that document today. The third one linked to that and to EP's comment is if we're going to be appointing a OCIO to handle the entirety of the alternatives portfolio, it makes sense to instruct the existing OCIOs to not make any new investments. And that's what Mike was talking about. So he's an official instruction, if you will, to make sure no new investments, no new liquid investments into the portfolio. And then the final point on kind of 6 and 7 is really, well, what's remaining? And 6 might be slightly new to some of you, but 7 is really just looking at how are we going to determine which 2 of the 3 OCIOs to retain. So, slide 3, this is really the kind of first vote for today. There's lots of information here. We really just tried to put, a label, set out step by step what this process will actually involve. We've also entered in some preliminary dates. These may be subject to change, but we think that they're reasonable. We're essentially shooting for a 4-month process from beginning, i.e. now, till when we envision a decision being made, i.e. the February trustee meeting. But things can change, but we've at least, for illustrative purposes, tried to set out what those dates are. And then for, Wilshire's cost in this, as I said, these sub-bullet points here, and I hope, Kurt and Teresa can kind of attest to it. It's a lot of work to kind of go into and really try and source who Wilshire believes a truly institutional specialist alternatives OCIOs, and then design a questionnaire to separate the wheat from the chaff, if you will, in terms of the quality of responses that we will receive in the RFP, and then essentially intimate participation from beginning to end throughout the entire process. And so what we're asking for today, should there be an RFP process, is that the trustee approve a one-off $20,000 project fee to be able to support Wilshire's partnership in this area.
Okay, so to make it easy, that is the OCIO Alternative Specialist RFP vote on the agenda, which would be 1A would be putting an RFP out for the alternative specialist, and 1B would be the cost The additional cost for Wilshire are $20,000. And we need to do that as one vote or two votes?
Two votes for
Two votes, two votes for that.
Can't imagine getting a yay for one and a nay for the other.
Right, right. But still, two
Might want to
votes.
make that mention.
Okay, so, the first would be for us to put an RFP out for the alternative investment OCIO.
Move approval.
We have a motion. Do we have a second?
Second.
Do we have questions? Yes, Ken?
Yeah, so if we go through this process, and I like the idea of having someone specialize in that specialized section of the investment, but, you know, to the gentleman's point, do we really need it? So if we go through this, we'll have 4.
No,
Well, we're gonna replacing one.
we're replacing one.
Replacing 1 and 3.
Okay, I missed that. And so does this, are we opening up the universe of OCIOs to, we're just gonna eliminate one of the existing ones? Okay. All right. That was my question.
Okay, other questions? No other questions? Do we?
So that's included in this process, they're gonna make a recommendation on,
Yes.
so with
Wilshire is going to make a recommendation as to which one to get rid of.
No, I don't.
As part of this process, Nathan, you can jump in.
Yeah.
Is also coinciding with this is a negotiation with existing OCIOs, which will help the decision on a fee restructuring based on moving more towards passive investments, and then that would necessitate a renegotiation and reduction in fees. So we'll find out through that process, that negotiation, where we get the greatest value. Correct, Nathan?
Yeah, that's correct. Yeah, I think Mac may have said, you know, you wouldn't approve 1A without approving 1B. I think there's an extent that you wouldn't. This is all interlinked, right? But by approving this, there's a vote later on in terms of what will be the selection criteria that the trustee will use to inform a decision as to, you know, which 2 OCIOs to retain, albeit on a reduced scope, and which to let go. And that's very much linked to this process. So as Ken said, we're not trying to expand the number of OCIOs that we're working with. We're trying to get the best value from the partners we're using.
So did the current OCIOs know that we were going to go from 3 to 2?
They do. I've had a briefing session with each of them.
So in this process, with the renegotiations of their fees, because we're moving more towards passive management, is that a pretty lengthy process, Nathan, to go through that, for them to come up with the negotiations they want to arrive at on fees? Are we going through a lengthy exercise for somebody who's not going to end up getting chosen?
I think that the most complex part of this exercise is finding the new OCIO, the alternative specialist, and that's why really Wilshire is going to be much more intimately involved in this.
Right, okay.
Which 2 of the 3 to retain? I think what we're going to be doing is really focusing in on the capabilities of each provider in the parts that, in this future world, that they'll be managing. So we're not, let's say, unfairly penalizing, make something up, but unfairly penalizing Greystone because they've had the worst US equity performance, where that may not be part of what they'll be managing in future.
But we can use leverage with the new OCIO to renegotiate terms in our favor. So whoever's not willing to play ball, so to speak, that's somebody who we can consider dropping.
Yeah. So I would say, we haven't put timelines on the selection criteria, but that's going to be a lot quicker, that information to compile and that negotiation process. And you'll see that, in the documents that are in the board pack. The alternatives RFP is something like, 12 pages, whereas really the evaluation criteria is 3. So, but yeah, Dr. Mike, you're exactly right. They're aware of this, and I think we've got pretty robust data to kind of say for OCIOs managing a largely passive portfolio or portfolio of just traditional assets, that they're going to need to sharpen their pencils on fees.
Okay. But in that criteria, I guess whoever is the lowest provider will end up who we're going with?
Not necessarily. It's still value, not cost, but that's going to be the point.
Yeah. Do we have an idea? And I don't want you to do this, but or don't have to answer the question. But is there an idea now as to who you think is not going to be around this time next year?
Let me answer that question when we get to the.
I told you not to answer it, but yeah.
Option A, B. With the intent with all of this and the way we phrase this in September is that this is an intent to negotiate with all 3 existing OCIOs.
Oh, yeah.
We're not kind of handcuffing ourselves to say if all of them say the only way we will work with you is at the existing fee schedule, we may come back to you and say we need to look elsewhere and provide the data to kind of support that. But I don't think that will be the case.
Okay, so we have the original motion. We have a first and a second and no other questions. All in favor?
Aye.
Okay. So now the next one is the cost, the outside cost for Wilshire of $20,000 to help us with this.
Motion.
We have a motion for that. A second? Okay, any questions? All in favor?
Aye.
Now, Kurt, please help me on this for minor changes for that.
So, if it's okay, what we're hoping was that if you look at the RFP, it'll have a list of dates, it'll have a couple areas where there's like yellow marks where we're just hoping that if there's slight modifications to the RFP, that you might give Teresa authority to make minor adjustments to the RFP as they're
Such as
finalizing
dates,
it.
if we have to modify the dates, something very simple on
Yeah,
this.
so did we approve the RFP or just the process?
Just the process, right?
Just
We
the
haven't
process.
approved the RFP itself.
Yeah, I had some feedback.
Oh, okay.
And so Teresa, were you going to be babysitting this process? 'Cause I don't-
Kurt, myself, and Deborah,
Okay.
and Wilshire.
Can I come along?
Sure.
Okay.
Well, no, you
cannot.
can't. You cannot, because,
That would be too
Sunshine.
yeah, that's right. Everybody can come.
Yeah.
Okay.
Do you want me to provide a quick overview of the main areas
Yes.
we're focusing on within the alternatives RFP? So this is slide 5 of this document. So I'm trying to blow it up a little bit wider for you all. Essentially, there's 7 sections here. Section 1, the minimum qualifications. This is really where we've kind of market tested this on an anonymous basis. We're setting a pretty high hurdle to truly get specialists in these more complex and sophisticated asset classes. So, for example, we're requiring that any respondee has at least 10 years of experience of managing a discretionary portfolio in each of the 3 buckets we currently invest in. So that's marketable alternatives, private equity, and private credit. We're setting minimum amounts in terms of the amount they currently manage on a discretionary basis, setting a minimum amount in terms of the research team. So this is the breadth that they deploy in each of these 3 areas, as well as the number of relationships and number of high conviction investment ideas they've underwritten over the past 3 years in each of these areas. We're seeking essentially a trusted partner relationships. So that's the transparency point. And Max helped a lot with this, the willingness to tie their contract to our IPS, for example, as well as willing to participate in the annual fee review, any manager dashboards that we run in future, And then finally, just to make sure that they have what we consider a minimum amount of institutional similar client types to NCHD. So that's the first one, and then really we just dive into lots of areas. I would say the nature of the questions are very similar to what we asked for in the OCIO dashboard, the qualitative dashboard, and we're really trying to peel back the onion as far as we can in each of these areas to make sure it's only the information that's relevant to this future mandate that they would be tasked with. I think the key areas, one key area, one that's kind of marked really highly on the evaluation criteria, is this clearly kind of track record piece in terms of manager research. We're asking for over almost any imaginable time horizon. We're asking for them from a blank sheet of paper perspective, how they would build a $110 million portfolio, which is broadly the allocation to alternatives today. And then obviously fees will be part of it as well, but it will be fees mixed in with the value that they're able to add. So you may remember a proof statement in September was looking at, we just chose one example alternative specialist OCIO, compared their track record to our aggregate 7-year track record, and said at the current dollar amount, this outperformance were to persist in future over 7 years, what is it worth? And it's worth tens of millions of dollars. And so again, the focus of this is really to get the provider that can, we believe, achieve the best net to fee return, and therefore the most amount of money that we can continue to give to the community year after year. I think someone, sorry, I didn't see who, but had a question on the RFP document.
Yeah, I mean, I had a question on the allocation of how you were awarded. And, if you could pick one criteria that you would use to select the OCIO, I would guess that it would be your prior track record investing in this space. You gave it a 20% weighting, as well as a 20% rating for the proposed alternative portfolio. And then the balance of is allocated a bunch of other things. And my only request would be that we allocate more weight to the history of their actual performance. I would hate to give it to someone who was a great communicator, exceeded all the qualifications, had a wonderful team, but really sucked at what they did. And so, there's the opportunity, because the track record only, history is the best indicator we have of the future. So if historically they've exceeded benchmarks, provided a good return, I would just suggest we weight that heavily, more heavily.
More heavily than
Okay.
the 20% already allocated.
Mm-hmm.
I mean, one comment I will make here that's not shown on this slide, but is shown on the document itself. This is the evaluation template to select the finalists, not the actual chosen provider. This is how we whittle down the long list to, say, 2 or 3 providers, and the intent is for those 2 or 3 providers to present to the trustee board in a selection meeting in February.
I'm not sure that changes my feedback.
Okay, we can take another look at the weighting.
I mean, I'm just one voice, so.
No, I mean, I think I'm not very experienced on this kind of stuff here, but to your point, Ken, I mean, track record history is a good indication. So, I mean, if we were to add another 5 basis points to the performance, where would we take it from, I guess, would be another question.
I think it exceeds minimum qualifications.
That's a good one. How relevant is exceed minimum qualifications, Nathan, in this process?
That would probably be the second point area I may have chosen from. I think there's probably an argument to say exceed minimum qualifications will naturally filter in to some of the other categories. So I'm not totally against removing that one and putting the track record from 20 to 25. I was going to suggest if we wanted, 5% shift to take it from reporting and communication.
Or experience with similar nonprofit clients. Either way.
Reporting communication.
Well, just to get this thing going, I suggest we add 5 basis points to the performance and take it out of reporting and communications.
Well, is that a motion? We have a,
They can make that change.
yeah, they.
We have to make a new motion to approve it as modified.
Yes.
We have
So we would need a motion to, because we've already approved the RFP.
Correct.
We just need to,
Or we could.
We've approved the process, not the document.
yes.
I'm moved that Teresa be empowered to make minor changes to the RFP as they come up, and then you can.
Well, is that considered a minor change?
Yeah,
to
that might get a little legally.
I think you heard the will of the trustees, so yeah.
Well, wasn't that the request earlier on that you'd be
Yeah,
able to?
but
Yes,
depending on
that's-
what is minor.
More dates,
not
so much.
We'll give you some cover there, Teresa, just
You got my back?
catch back.
Okay.
We can say within 5%.
Well,
Just put it.
let's just make it easy for Teresa, let's just, I'll make a motion to amend the RFP, right? Second.
What I think we ought to do is make a motion to approve the RFP as amended. And if we can reach a consensus on where the basic points are coming from, where they're going to be distributed, and then make a motion to approve it as amended. Would be a
Okay, so we need to have a motion to approve the RFP
as amended.
as amended.
And then we need to decide what the amendment
You heard what Max said? Do we have a motion?
I'll make a motion to approve the amended.
Okay. Do we have a
Okay.
second? Second. We have a second. Questions? All in favor? Okay. Now we need to amend the RFP that was approved.
Correct.
I will make a motion.
Go ahead.
Go ahead, Nathan.
Oh, no, sorry, if you're making a motion, I'll shut up.
Okay, all right.
Then I will make a motion to amend it to reflect that we are going to take performance to 25% and reduce reporting and communication to 5%.
Okay.
Second.
We have a second. Any questions? All in favor? Aye. Motion passes. Okay. All right, go ahead.
On a side note, just based on Ken's feedback, when they do all this, we have like a 6-month period, Ken, so we should discuss another workshop to discuss, when they do narrow it down to 3, how we're going to be more, so that we kind of agree on that in advance, on those percentages.
Well, typically we would keep the same percentages
I understand that, but
And-
they said that's not what we have.
For the final.
for the final.
Okay, I thought this is.
So when it comes to the final 3, Nathan may have a different strategy, and we just like to see that in advance, so we can.
Okay.
Fair enough?
Yeah.
Okay.
Does that clear, Nathan?
Yeah, that's clear.
Okay. All right, so moving on to you want to continue, Nathan, with the next?
Yeah, this is wording drafted between myself and Mac to essentially request that all existing OCIOs during this RFP process don't make any new alternative investments. And so let me just kind of clarify that, because particularly for private markets, the way it works is they could have made an investment in January, and that, let's say for $1 million, but the first $250,000 of that will only be called, but would only actually invest in December of this year. We can't stop that. We've already legally committed to that. But what we can do by sending this italicized wording to each provider is not to enter into any new investments. So when Mike was speaking and he mentioned the Harvard 2025 $1 million intended commitment, this will essentially stop that investment until we've gone through the entire selection process.
Is there everyone understand that?
And I think this needs to be phrased as a motion to approve an instruction to the current OCIO providers to cease entering into new alternative investments, be how we phrase it.
Okay, so we need a motion that says just.
What he said, we do what he said.
We have a motion. We have a second from Marita. Is that correct? Yes. Okay. Questions regarding this? All in favor?
Aye.
Motion passes. Anything else?
The only thing I wanted to mention is, it's probably a good practice, Nathan and team, is what you guys did leading up to the workshop where you guys met one-on-one and provided educational sessions. I think that'd be a great idea as we get closer to the end of the weeding out process of the RFP, where you do the same thing and do one-on-ones and educate them about the process, what you went through, answer any questions, and that way once we get to the workshop, they have a significant amount of information about what you guys worked on.
Okay, no, that's great. We'll absolutely do that. So look for that. That will probably be in the new year before the workshop.
Okay.
I think two more, and then we'll be done. So the first one, so you may recall for those present at the September Investments Workshop that switch sides, but the left-hand side is essentially by approving the RFP process, what we've just approved, right, is that we're not changing at a total portfolio level how we are invested. We are just initiating a process to change who does that investing. And what we had proposed was, for the remaining 65%, that 2 of the existing 3 OCIO managers be used. But if we really wanted to target another area of underperformance, but within what we're calling traditional asset classes, it's a 20% allocation within public equities, so 20 of the 25, to US equities, just to move to a 100% passive implementation. That's been, as all 3 of them have admitted, one of the main headwinds to overall success of active management, both in terms of large cap, small cap, growth value, as well as whether to be active versus passive. And then as we were thinking of this between September and now, I've had some conversations and some thoughts to say, if the trustee board, and it is an if, the trustee board is happy to move to passive management and doesn't believe, over a long period of time that active management within US equities can add value, then there's very little reason to actually use an OCIO for that. And so I've had a conversation with Mac to say, 11 years ago when this corpus was put in place, is there an ironclad rule to say that we must use an OCIO, it must be a delegated decision of whether to use active versus passive management. I think this is why we're showing option B, that at the time 11 years ago, there was a much stronger belief in active management outperforming a benchmark. And obviously the reason we're having all of these conversations is that 11 years later, in aggregate, it hasn't. And so, an option to further reduce cost is actually to take US equity, to take cash, so $80 million or 25% of the total portfolio, and actually just invest directly in a mutual fund. And let me just distinguish that very clearly, or as clearly as any Brit can, is by direct investment, it means that this money would not be on an OCIO's balance sheet, would not be subject to any OCIO fees. But it does not mean directly owning NVIDIA, Facebook, Google, etc. It would be, ownership, for example, in a Vanguard index tracking fund. Similarly, the cash allocation would be ownership in a US money market fund. The idea with option B here is really the benefit is that you save the OCIO fees on these assets. So you look at currently about 20 basis points, so call it $160,000 a year. The con caller to this option is that even though it's not an OCIO, technically we would move from having 3 pools of assets to having 4, right? We'd have an alternatives, who's running the alternatives, would be using passive management for 25% of the portfolio where we don't think there is value in active management. And then in the parts of traditional assets where we think there is still value, that's where our existing OCIO managers 1 and 2 come in. So that's an option. And we have created a selection criteria both for option A and for option B for Truist Crossing Greystone.
Well, I think additionally the reason we also, Kurt was there, I was not there, but the OCIOs were picked to put a layer between the trustees and the investments. But that would eliminate that layer.
On one of the spheres it would, right?
Mhm.
Yeah.
Possibly not, because we wouldn't be directly investing, we would be investing in a mutual fund, which is managed by a mutual fund company. So that layer.
We're not picking stocks.
We're not.
Right, I realize that.
Right, so we wouldn't be making the selections from a fiduciary standpoint.
Who would manage it though?
Who would pick the mutual fund?
Yeah, and then who would say get out and get in?
Who rebalances, who liquidates cash?
Right.
Nathan?
Yes, so I think I had the question, who would, advise on the mutual fund? That could be Wilshire. There's a clause in our existing contract that essentially could cover that. And so, there are a number of, we're talking tens, if not hundreds of billion of dollar sized funds who there's no skill involved. It's literally a computer tracking program which is owning a proportion of all of the listed stocks in the US market. So there's no active decision in terms of large, small, growth, value, or picking stocks. It's, I use Vanguard as an example. It doesn't need to be Vanguard. But in that example, on the shareholder record of all of the underlying companies, Google, Meta, NVIDIA, etc., it's Vanguard who's listed on the shareholder list, and it would just be MCHD who's a beneficial owner of a proportion of a Vanguard mutual fund.
Okay.
So when equity markets go crazy like they are now, it's going to cause an imbalance to the portfolio percentages. How does that get corrected then, Nathan?
So, great question, Matt. The investment policy statement has rebalancing ranges. So we'll go back to it, but those are the kind of horizontal bars that were shown in Efi's chart earlier on. We have monthly meetings, and so to the extent that we actually go out of them, right now we have, apart from trying to put pressure on the OCIOs, we actually have less ability to correct it than we would under this proposal. Because, again, I go back to the example of the Vanguard fund. If that is the single fund that is owned for 20% of the portfolio on the US Bank website, then it's just as simple as, let's say it was overweight to US equities, to sell out of that and to put it into whatever is underweight. So that could, there's a much simpler mechanism to deal with that than there probably is today.
But you would, Wilshire would physically coordinate that?
Yes. With the partners, right? So what I mean is that if money, let's say, is going into international equities here, that would still be with an OCIO. Right. So, we would help coordinate with the money.
You would sell Vanguard and transfer the money or put it into cash or wherever it needed to be rebalanced.
Yeah, we would be part of that. So I think that that's something that we raised in the key selection document, right? Is that we would need to make sure that the appropriate permissions are in place. So that would be part of option B as well. So whether it's directly Wilshire doing it or whether it's Wilshire kind of advised and MCHD actually executing it. and things like that. Those are some of the minor details that we would need to iron out.
And fees for that on your part?
So the provision of a passive fund recommendation is already covered with our scope of services. For depending on how active the rebalancing is, that we might need to look at that. We may need to look at that. I mean, certainly in terms of the kind of cost-benefit analysis here, we're talking very small amount versus the OCIO fees would be saved.
So then we're down to, what would be the dollar amount that would be under management, existing COIs under that plan?
129 plus, 129 would be split among the two.
So there's
64 and 64.
Okay.
Yeah, this is, maybe slightly more than this. I think this is August 31 values, not September 30, but yeah, in those proportions, 25, 40, 35, so.
And we don't know what their fees would look like managing that small amount, but.
Well, then,
yeah.
That's a question, we need to go to one COI.
Yeah.
COI.
Well, you have the special assets.
OCI.
And then, it makes the argument of going down to two plausible. So.
Going down to,
two OCIs. You're gonna have one doing the alternatives.
Yeah, it's up to, yeah.
And then one doing the, whatever it is, core funds.
Exactly, yeah.
So Nathan, no, the A or B, that probably will be after you start negotiating, right? Because depending on how willing they are to adjust their charges may dictate which way we go.
Well, also how many assets they have to manage.
Right, they may.
Exactly. This could be an area that we don't need to definitively decide on today, but could kind of keep open to it, and we could come back to you. So the subgroup delegated could come back to the trustee board and provide an update, and then the implications for options A and B and come with a firmer recommendation kind of down the line as we begin the negotiation process.
Okay, so let's table this for now.
Okay.
I do appreciate the creativity though.
I thought you might like that, Ken.
Well, he's a rule breaker, so.
Final point, this should be quick, and again, this, I don't think any of this is a surprise, right? How are we going to decide what to keep? Like, one, it kind of goes back to track record, but track record specifically in those parts of the portfolio, and specifically in the kind of active management parts of the portfolio, right? Because I think there's probably a desire, whether US equity is held with the ICAO or directly, that it be passively managed and we kind of cut out this ongoing bleed from the portfolio. And then, there are some more qualitative parts of it in terms of investment philosophy, really looking at how they would design the portfolio. There is the fees, which is probably one of the key elements of it. And then, we would just make sure that the data we have that's fed into our quarterly OCIO dashboard within international equities, fixed income and public real assets is up to date with us, and to kind of submit one piece of research per asset class that we would score. And then finally is the kind of point on client service, MCHD requirements, and not least of all, their willingness to proactively participate in this process, which would include the transfer of over a third of their portfolio to a specialist OCIO. So these are the criteria. Again, we haven't put kind of a scorecard on. We've just tried to, hopefully it's kind of obvious, why we're choosing these areas to focus on, but welcome any feedback. And if not, and again, subject to the same provisions that, Kurt and Deborah said before in terms of very minor tweaks, we would propose that this is the kind of key selection criteria that we would use to determine which one or which two OCIOs to retain.
Okay, is that something we need to vote on? I don't think so. Okay. All right, anything else for Nathan? Thank you.
Thank you, Nathan.
Thank you.
Thank you.
All right.
Thank you.
Thank you all.
Thank you very much.
Take care now. Bye.
I have a question. I know we're in the sunshine law, we can't, but wouldn't you be allowed to have a workshop committee, or would it be too complicated? So like, if others wanted to sit in, they could.
We could do it as a workshop, as long as it's noticed properly and.
Yeah. It's just a thought. I mean, if, I don't know if Ken.
I don't see it, we're not taking any official action. I don't see any issue with that if we just did it as a workshop.
Yeah.
So maybe discuss that with Nathan, he may or may not be comfortable with that.
Okay.
If he is, it would be a way to.
Yeah, man. You request enjoy the process.
He might not, but.
No, he'd be fine with it. I think it's more just, and then everyone, would have access.
Forum to have a workshop? We don't
Yeah.
have. We do have.
In order, right, we have to have quorum for
Yeah, we have to have a quorum for it.
So that's
So it
three.
could be
So 3.
It would make it, I mean, you could do like your preliminary stuff, and then you could just.
Are you talking about the getting Ken's involvement in the RFP process?
Yes.
Okay. No, not just, I mean.
Not just him, but just.
No, I understand. Yeah, I didn't get that.
If we wanted to.
Yeah.
It was a way of doing it.
That's right.
If we don't.
That's the only way to do it.
I
Is to have a workshop.
Right.
Right, that's what I was thinking.
Okay, I'll talk to Nathan. We can talk to Nathan. All right,
Oh, it's me.
it's you.
Or you.
Thank
Sorry.
Take it away.
I'm starting to fade really quick, so I need to,
Go.
So, just, the first is just an FYI. Freedom Clinic has a couple different grants with us for dental services as a safety net for the community. They received a grant from another source that reduced their need for one of the grants that we provided them. The grant that we approved for dental services was $113,934. They received a grant that was approximately $33,429. And so the FYI is they went from needing the $113,934 that we approved to $80,424. So that's a good thing, because we always work with our grantees trying to find alternative sources. As a follow-up to that, they could use some of that funding back. Just a little bit. So staff, particularly Brandy, works hand in hand with our grantees and Freedom Clinic quite a bit. And the collection of data from Freedom Clinic, they're one of our larger grants, and they have a lot of individual data from clinics and particular services. And so we've been trying to automate their system for some time. And so there's an interface that will automatically pull down specific data fields from their software and their electronic health record system into our Mindshare. And that interface, it's mostly consulting fees, but it's a one-time cost. We request, but it's Teresa's vote. She holds the gavel. The cost of that would be $8,769 in order to complete the interface, so we can collect data and automate it.
She said please, so we.
I know, she said, and it will decrease errors in the data that's coming in.
That's one of their weakest things they have,
Yeah.
right?
So just based on the write-up, it says it looks like the cost is $14,872. The savings of doing that would be the $8,760.
So they already had in their budget the difference between $8,769.
Oh, okay.
And so it was already in their budget.
Got it. So I got a motion.
We have a motion. Do we have a second?
Second.
Any questions? All in favor? Aye. Motion passes. There you go. Thank you.
Operations balance scorecard, Crystal, next.
Moving approval.
What?
It's getting warm.
You ready? You got 15 minutes. You can do it. All right, so most of y'all are here. We recently had a workshop, a balanced scorecard workshop with Paul Niven, who literally wrote the book on the balanced scorecard, and its usage to ensure that the company's vision is fully executed. As part of preparation for the workshop, we actually had the opportunity to give Mr. Niven a copy of our balanced scorecard and ask for feedback because we were very interested in what he had to say. Mr. Niven's feedback was that our current scorecard clearly captured our organizational goals, and we should continue along the same path in order to track ongoing improvement over an extended period of time. That does not mean, obviously, that there won't be changes, tweaks, because we are constantly growing as an organization, so we want to constantly be reevaluating our balanced scorecard. But we should keep the base the same so that we can track our progress or lack of progress over a long period of time. I am happy to share that this year's balanced scorecard reflects another strong year for the hospital district with continued progress across all our 4 key areas. Our key areas, as a reminder, are customer, internal operations, employee development, and financial performance. Starting with our customer measures, community awareness and satisfaction continue to rise with over 11,000 surveys completed. For some context, 2 years ago, we started asking for customer satisfaction surveys, and we had 450 completed for that year. The next year, we had just over 5,000. So this year, we are doubling, more than doubling that, those customer satisfaction surveys. In addition to them completing the customer satisfaction surveys, we're getting good feedback. We are getting positive feedback. Positive feedback is not something that you always get in this area that we are focused on, but we are getting it. And we're not just getting numbers. If you do have a chance to look at Mindshare, we're getting words, we're getting recommendations, we're getting encouragement to employees in these organizations that we're able to share back to the organizations and tell them how they're doing. We've also made significant progress under our new strategic pillars of unintentional injury and prevention. We are participating in the HCA DOH Fall Prevention Coalition. We have expanded through partnerships with Harlow's Hands on Drowning Prevention and planning with Marion County for a hands-only CPR initiative. Additionally, we have funded gallery testing through the Vet Resource Center, and we have helped Marion County Senior Services get a card. Through our heat mapping, collaboration with core partners, we have identified underserved areas in southwest and southeastern Marion County, as well as along the State Road 200 corridor. These findings help us better target research and guide funding priorities. This includes, next year, we will be scheduling a health fair with the Vet Resource Center out on the West 200 corridor. That will bring in partners with fall prevention, hands-only CPR, and anybody else that we can get out to that side of town, because that is not usually where we are focused, but there is a big need. Overall, the district had over 200,000 community impacts last fiscal year. It's important to know that even this number does not include ongoing impacts from capital projects or partner programs that the hospital district manages but not directly funds, such as the management of the opioid abatement funds and domestic violence appropriation funds. When those are factored in, our true community reach is even greater, demonstrating how the hospital district's leadership extends beyond direct funding to broader system coordination and support. Our grantees, they also achieved 82% of all project performance goals, which is a 5% increase over last year. Projects that fell short have already undergone in-person reviews with myself or Randy or other staff members to identify barriers and outline specific improvement plans for next year. We hold our grantees to a very high standard by setting our goal at 90%, but we believe that this is imperative to them pushing themselves to consistently be greater and serve more Marion County citizens. This is a goal that we do not necessarily want to consistently achieve. We want to make it hard to meet purposely. If it is meant to consistently, we really should be reevaluating our benchmarks. Internal perspective. Internally, the hospital district met or exceeded every key goal. We completed 100% of grantee reviews and site visits, ensuring full compliance and documentation through Mindshare. Digital engagement grew significantly with each of our major programs surpassing 1 million impressions, greatly enhancing public visibility. The hospital district also successfully completed a community-wide event over at CHP with participation from 75% of our funded partners and multiple community organizations. Employee development. Every staff member at the beginning of this year worked with their supervisor to establish measurable professional development goals and complete training aligned with their roles and the district's mission. All staff have met the required 15 training hours and have visited 5 external sites to explore innovative practices from across the state to see what we can bring back here to Marion County that will benefit our citizens. We also have begun evaluating new performance management software to strengthen the link between staff development and organizational outcomes. Financially, I think we've gone over that tonight. We remain strong and sustainable position. Our investment portfolio closed well above the 4% goal this year. We also secured $500,000 in new appropriations to domestic violence services, and through our partnership with SMA, we helped them successfully add 22 new residential treatment beds, generating more than $1.6 annually in new substance use treatment funding for Marion County.
Matt, how do you feel about being responsible for our rate of return?
Did a pretty good job.
Crushed it, dude.
Good job. In summary, this was a year of growth, collaboration, and measurable community impact. We strengthened partnerships, advanced new strategic pillars, expanded our reach while maintaining financial health and organizational excellence. As we move into the next fiscal year, our focus will be on strengthening data accuracy and validation, and always is, across all programs to ensure impact from capital and partner-managed projects are fully captured, advancing our unintentional injury and prevention initiatives and expanding outreach to underserved areas, continuing to align funding decisions with measurable community outcomes, enhancing employee development systems, and exploring technology that support more consistent performance evaluation and reporting. Over the next month, and we will all be working on updating the scorecard for the new fiscal year. While, like I said, we do want to keep some measures consistent so that we can track growth over a long period of time, we will be amending some measures to align with further growth and to keep up with the growth of Marion County itself. If you have any additions, suggestions, etc., don't hesitate to reach out to any of us, and please give us your feedback. We are welcome. We intend to bring the new balanced scorecard in front of you all next month for approval. Questions?
Great job.
Very good. Thank you.
Thank you, Chris.
I do think Matt doesn't have the ability to influence that result area. So I think that's a leadership / board responsibility.
I mean, Matt does it very well.
He said he doesn't have the authority to make any decisions to influence it.
I think it was more for who's responsible for tracking.
Yeah.
More placeholder.
Yeah.
I just give you information.
Well, it says to earn a rate of return.
Yeah,
Okay.
he's the calculator of our return. But
That's how much we need to make it enough.
Got it.
Crystal, thank you.
Well, that's actually a very important thing that if he's responsible for tracking it, he's doing a great job. Good job. But one of the most important things that we have to do is manage that corpus, and that probably needs to be at a more significant place on our scorecard. How are we doing? And we do a lot of work. I mean, most of today's meeting was about that result area, and so.
That's something that's generally covered, just like you said, under the investment category, not under the balance score. Okay, Matt.
Packet beginning on page 68 of the financial statement for the month of September 2025, as well as year to date, which also aligns with our fiscal year to date. So you'll see the term unaudited used throughout the statements anytime we present a September 30th balance, which is our fiscal year end. Until it has been audited and approved by the audit firm, it will be listed as unaudited. That just means that we don't have an official letterhead on it yet. There are changes that definitely happen between now and
March when those statements are issued, mostly related to investment balances. As mentioned before, some of the alternatives are a month behind, but some of them are 6 months behind in reporting theirs. So adjusting the valuation, we also are capturing any obligations that come in after year end related to the September 30th period. So, but you know, as discussed in the lengthy investment portion, the month of September experienced significant investment gains. So the biggest component of the balance sheet still remains and will be for a long time the investment balances. And year to date, the return on investments, including interest and dividends, is $23 million. So a really strong year for the investments, which drives the balance sheet significantly in a favorable position, as well as the income statement. So that's the big takeaway from all of this. Over the next 4 months, we will be supporting the audit. Purchase Grading Company is a local CPA firm that conducts a financial statement audit. Our team, as well as management, supports that process, and they present generally in March when everything is wrapped up. Otherwise, the budget and to actual, which I think is probably the one you guys focus on the most, was pretty much in line with what we discussed when we were approving the budget. The underspend was recaptured and was pulled into the current fiscal year's budget, and we will ratify that. We'll bring that information to the board for ratification when the audit is final and the numbers are final as well. And that's about it. But we were under budget as an organization. So, any questions about the financial statements included in the packet? If not, we do seek a motion.
Okay, so if there are no questions, we need a motion to approve the financials.
So moved.
We have a motion, we have a second. Any other questions of Matt? Hearing none?
No.
All in favor? Aye. Motion passes. Do we have any old business that needs to be discussed? Okay, open discussion. Anything?
Oh, and the Beacon Point parking lot. Should be ready to go up for bids. I don't know what the process is, like they would handle that, but we should be ready to go for bids.
Excellent. Thank you for all your work on this.
Thank you.
What did he say?
We're one step closer.
We haven't done it yet.
This is, like he said, we're one step closer. Any other items for discussion? If hearing none, we are adjourned. Thank you all very much.
Tracy.